Okay, let's talk about something that completely blew up the financial world. Meme stocks. You've seen the stories, right? The insane gains, the devastating losses, this whole online movement going head-to-head with Wall Street. But the big question is it a smart move or just a really, really dangerous gamble? Let's break it all down.
I mean, you remember it, right? GameStop, AMC, Reddit, those names were absolutely everywhere. It seemed like overnight these online communities, especially Wall Street bets, were making stocks go, well, completely parabolic. But what was really happening behind all that chaos? Let's dig in.
It really all kicked off with one company, a name that became the poster child for this whole movement. Yep, the GameStop saga. That was the spark that lit the fuse on this entire thing. Just look at how fast this unfolded. In early January 2021, GameStop was, just a struggling video game store. A lot of big hedge funds were betting it would fail. But then, Reddit's Wall Street Bets community decided to rally behind it. They started buying up shares like crazy, which forced the big guys to buy back their own bets at way higher prices. The stock just exploded. We're talking in a matter of days. And then, almost as fast as it went up, it came crashing back down. It was a perfect and kind of terrifying example of the insane volatility we're talking about.
Okay, so we've seen the drama, we've seen the chaos, but what even is a meme stock? What does that term actually mean? Let's get a solid definition.
At its heart, it's pretty straightforward. The value of a meme stock has almost nothing to do with how well the company is doing, its profits or its products. Nope, it's driven entirely by social media buzz, viral hype. It's basically an investment trend that could only be born in the age of the internet.
So, what are the key ingredients that make a meme stock? Well, a meme stock. First, you need that viral popularity. Then you have this collective action by everyday people, what Wall Street calls retail investors. And here's the crucial part. It's totally disconnected from how the company is actually doing. In fact, a lot of these companies have what's called a huge short interest. That means big firms are literally betting the stock price will go down. This creates a perfect storm for insane volatility, all fueled by the power of small investors teaming up.
But look, this is about way more than just numbers on a screen. To really get what's going on, you have to understand the community, the culture, the vibe behind it all. It really is a classic David versus Goliath story.
And this quote right here, it just nails the feeling of the whole movement. For a lot of these folks, it wasn't just about making a quick buck. It was about sticking it to the man, leveling the playing field against a system they felt was rigged. It was almost like a digital protest, using the market's own rules against the big institutions.
And like any good online community, they developed their own language, their own slang. First up, you've got diamond hands. This is like a badge of honor. It means you're holding onto your stock no matter what, even when the price is going absolutely bonkers. It's all about that unbreakable conviction.
Then you have tendies. Yeah, tendies. It's just a playful, kind of ridiculous term for profits. And it really shows you how much of this felt like a game. It wasn't about long-term dividends. It was about scoring a big win.
And of course, the big one, the rallying cry for the whole movement, sending a stock to the moon. It just perfectly captures that boundless optimism, that belief that together they could push a stock price to unbelievable, astronomical heights.
Okay, but here's the thing. For every glorious trip to the moon, there's the very real risk of a painful, fiery crash back to Earth. So now we have to talk about the other side of this coin, the serious dangers, the insane volatility, and the big questions regulators are asking. And it's so important to get the difference here. Think about it like this. Traditional investing is like being a detective. You're looking at clues, a company's financial reports, its growth plans, its real value. Meme stock speculation, that's more like surfing. You're not analyzing the ocean. You're just trying to catch a massive wave of hype and social media sentiment driven by that powerful fear of missing out, or FOMO. And don't think for a second this is old news. Just recently, in June 2024, a single post from the influencer Roaring Kitty, a key figure in this whole story, made GameStop stock jump almost 50% in a single day. That is not how a normal market works. That's the raw, unpredictable power and risk of pure hype. So, what's helping to fuel all this? Well, there's this concept called gamification. Basically, it's when trading apps are designed to feel less like a boring financial tool and more like a video game, with flashy animations, points, rewards, all designed to get you to trade more often.
And this creates a really powerful and kind of dangerous feedback loop. Think about it.
You get a push notification on your phone. It creates a sense of urgency. That kicks your FOMO into high gear. And before you know it, that emotional rush leads you to make an impulsive, high-risk trade you probably wouldn't have made if you'd had 5 minutes to think about it.
Yeah, and regulators are definitely noticing. This quote from a former SEC investor advocate says it all. The big worry is that all these game-like features are subtly pushing people to make riskier and riskier bets, essentially blurring that very important line between investing and flat-out gambling.
So this all brings us to the million-dollar question, right? After looking at the culture, the incredible hype, and the very real risks, what's the bottom line? Is this actually a good idea?
Let's just ask it plainly. After all of this, is investing in meme stocks a good idea for, a normal person? This quote really puts it perfectly. Trading meme stocks is like riding a roller coaster. It's an adrenaline rush for sure, but it is absolutely not for everyone. You have to have the stomach for those terrifying drops, and maybe even more importantly, you have to be financially prepared to, well, lose your money if the ride goes off the rails.
So let's break it down. Who is this for and who should stay far, far away? Look, if you have a really high tolerance for risk, some extra cash that you would be okay with losing completely, and you have the time to be glued to your screen, maybe it's something you'd look at. But, and this is a big but, if you're saving for something important like retirement, if losing a chunk of money would be devastating, or if you actually want to invest in a company because it's, a good company, then this is absolutely not the game for you.
So here's the final verdict, plain and simple. For most people, and I mean the vast majority of investors, the insane volatility and the complete lack of connection to a company's real-world value make meme stocks a really unwise choice.
And if you need any more proof, just look at this. Back in 2021, a professional investment firm thought they could crack the code. They launched an entire fund, an ETF with the ticker symbol MEME, dedicated to these stocks. And what happened? It lost a ton of money. And by 2023, just 2 years later, it had to shut down completely. I mean, if the pros with all their resources couldn't make this strategy work, that should be a giant red flag for the rest of us.
So, where does that leave us? Well, one thing is for sure. The whole meme stock saga has revealed the undeniable and, frankly, shocking power of collective retail investors. It's proven what can happen when thousands of small investors organize online. But the real question is, was this just a bizarre, once-in-a-lifetime fluke? Or is this retail rebellion going to change the rules of Wall Street forever? I guess we'll have to wait and see.